Thanks very much. Hi, everybody, and welcome to the Business Renewables Centre Australia's Buying Power webinar series. Today, we're going to hear a little bit about last year's highlights from the corporate PPA market in particular, and also insights for 2023. So my name is Jackie McEwen. I'm the Program Director here at the BRC-A. And for those of you who are new to this series, we provide and to BRC-A, we provide renewable energy procurement, training, connection, and energy markets information to support organisations seeking to decarbonise their operations and lead industry. Our purpose is to drive a business-led renewable energy future for corporate and government energy users across Australia. We are a membership organisation, and our members span both the supply and the demand side of renewable energy procurement. And we are a partnership of Climate Kick Australia, Institute for Sustainable Futures, and WWF Australia. So before I start today, I'd like to acknowledge the Gadigal people of the Eora Nation, the traditional custodians of the land on which I'm located in Sydney today, and the traditional custodians of the land where you are today. And I pay my respects to their elders, past, present, and emerging. So thanks to everybody for joining us today. We have a record number of registrants today in the 400s, which is great for any meeting held on a Friday, in my view. Before we launch into today's important topic, so that you can hear a little bit about what we might see this year, I'll give you a quick update on what's happening at the BRC-A. Next slide, Alex. Thank you. So BRC-A, obviously continuing to do a lot of work in the training and resources areas, but also a couple of points to mention for our buyer members in particular, and our new website. So BRC-A is supporting the City of Sydney, City Switch, and the Sustainable Destinations Program, providing a new masterclass training series for small to medium energy buyers. If this is you, this course will provide you with a practical how-to series covering green power and LGCs on the 15th of March online, and then we'll dive into three sessions on retail PPAs, and this will also include a session on aggregation. So jump on our website, you can have a little look, or the City of Sydney websites for more information to register for those. They are free. We have our Buyers Boot Camp, our popular training coming up in April, May. So we will give you dates for that very soon, I hope. We'll also be holding Developer Boot Camp and networking events shortly. We've also got a couple of new resources on our website. So if you haven't seen the new website, jump on and have a look. There's a new user-friendly filtering function there that is very helpful for sorting through our 22-odd guides. We've got the new local government guide that has been released, prepared with the support of the New South Wales government. We've got a whole lot more resources coming on supply chain, how to talk to your supply chain, sustainability self-assessment guides, and those sorts of things. So take a look. Another really important thing just to mention today before we get going is for our buyer members. I bumped into quite a lot of you at the Sustainability Leaders Summit in Melbourne the last couple of days, and mentioned to you that we will be providing some new pieces of support that really reflect the way our corporate buyer market is evolving. And while PPAs and renewable energy procurement is new for many of you, we've listened to you and heard that you want some evolution of our services. So we're going to be providing some bootcamp refresher training twice a year, providing market updates just to help you to stay abreast of market changes, and also policy changes. Not everyone has a policy specialist within their organisation. And on that note, we will be forming a new buyers policy roundtable. We will be focusing specifically on renewable energy procurement and the policies impacting your renewable energy procurement, be that in the future or something you're contracting now, to facilitate the discussion between buyers and the policymakers, as well as buyers themselves. So watch out for that one. We'll also be holding some executive briefing events for market leaders in renewable energy contracting. And we're also developing some services around promotion of your renewable energy contracting achievements and providing some internal, external corporate communication support. So as I mentioned, jump onto the website or get in touch to find out a little bit more. So also, I should mention we will be introducing our fee-paying buyer membership, which will enable us to deliver these services, and we'll be offering trailblazer memberships for companies looking to lead with their support for industry in this space. So now on to today's session. Our annual State of the Market, State of the Corporate PPA Market, importantly, report for 2022 was released in full today on our website, so you can download it there. And no surprises, it was our biggest year yet since we began in 2017, 2018. We saw a range of deals, a large range of deals, from very large deals, Westpac, Wesfarmers, industry-leading deals encompassing supply chains such as by Apple, to aggregation deals from IFM investors and councils groups, and smaller service providers like Bupa and HSF. So after 2 years of retail PPA growth, we've really also seen the return of wholesale PPAs to the market. So to tell us about the year, Chris Briggs, our Technical Director at Business Renewables Centre and Energy Lead at the Institute for Sustainable Futures, will provide a brief presentation. Following this, we will hear from 3 market experts about their views of the year ahead and what you should be looking out for when contracting this year. We'll then have time for questions at the end, so please don't hesitate to send some questions through in the chat. And so I'll hand over now to Chris. Thanks, Chris.
Great, thanks, Jackie. Yeah, so I'm going to give a bit of a context-setting presentation. Oops, got to go back up to the start. Quick preview. A context-setting presentation going through the key highlights of our State of the Market report before the panel talks about the outlook for the coming year. It's based on our annual State of the Market report, as Jackie said, which is based itself on an industry survey, on our own agreement database, on stakeholder input, particularly through our market advisory panel, which has a cross-section of practitioners. And the aim of the report is to provide an annual profile of the market, highlight some key issues and perspectives, particularly from the viewpoint of buyers, and identify some key and emerging trends for people to consider. So the highlights this year, firstly, as Jackie said, it was a record year in terms of deal volumes. Probably the key market event this year was the unprecedented wholesale electricity prices and the volatility and the suspension of the national electricity market. So we surveyed buyers and advisors on the impacts of that. And we found, I guess, contradictory impacts, both a short-term surge in demand for PPAs, but also some uncertainty and paralysis and disruption for other buyers. One of the most striking trends was there were very few PPAs with new projects. Really, until one large deal late in the year with Microsoft, there was very little, and we'll unpack that a bit. I think that, I guess our view is that it's primarily cyclical, and we should see a bit of a return in the coming year or so. And that broadly, I think the market actually looks, notwithstanding that, looks quite healthy. It's always a concern to see a dip in PPAs with new projects, but we still see a healthy market with a really diverse set of buyers and a really strong alignment between the financial and net zero drivers that tends to underpin the growth in the sector. So I'll unpack that a little bit more now. So here you can see the volume of capacity contracted through corporate PPAs year on year. And you can see a list of major corporates that signed significant deals this year. I think the second trend is that we saw a lot of buyer groups emerging, particularly amongst councils, regional councils who were getting together to sign PPAs. And the third clear segment was a collection of smaller service sector buyers who are signing net zero targets. Aside from the record this year, I think the thing to highlight is that 4 out of the last 5 years, there's been deal volumes of around 1 gigawatt or larger. And that probably starts to set a bit of a base or a benchmark for what you might expect this year. It's rare now to see it dip beneath that. We track the different types of buyers and market segments for large-scale renewable energy. Each one of these columns shows you the market mix for a quarter. And if you focus on the right-hand side, you'll see a lot of orange, which is the corporate PPAs showing their importance. Secondly, the red segment are the state-owned utilities, in particular Queensland organisations like CleanCo that are quite prominent. The aqua blue is government running auctions for policy purposes. The one on the far right is the Victorian Renewable Energy Target. What's missing is the dark blue, which is the traditional avenue, of course, the retailers signing PPAs for their own portfolios. And we would probably expect to see that starting to tick back as we get closer to coal closures and see policy instruments like the RESs come back into play, but they've still been quite scarce over the last couple of years. So it's really been the corporate PPAs and the state-owned utilities that have continued to drive the large-scale market. When we survey buyers and ask them what's the primary driver for them entering into a PPA, we get a very consistent result really year on, year out. Number one is a greenhouse or renewables target. When you add that to CSR or ESG goals and reputation, around 2/3 of buyers are nominating a non-price driver for why they're doing a PPA. And then equal numbers, more or less, looking for lower electricity prices or looking for electricity price certainty. And given, of course, the volume of organisations that sign net zero targets, it really underpins why you sort of got quite a strong growth, or expect strong growth. The other factor is that we continue to see strong diversity across buyer sizes. So we categorise the market here by less than 20 market, 20 megawatts, 20 to 50 megawatts, 50 to 100, and then the large ones of 100 plus. And it obviously fluctuates from year to year. But I think the thing we take out of this is that we see an established market now with vehicles and mechanisms for different buyer sizes and different buyer types. As Jackie mentioned, last year we were almost ready to write the obituary for wholesale PPAs. They seem to be disappearing as larger buyers seem to be preferring to sign retail PPAs for lower administrative costs and simplicity. But we've seen something of a return of the wholesale PPA. So the wholesale PPA are ones signed directly between a project and a buyer, also known as a financial PPA or a contract for difference. Why is this happening? It may partly be the cohort of buyers. There were more international buyers who are experienced with wholesale PPAs, but it also seems related to the rising costs of firming. In particular, I guess cap contracts and baseload futures going forward has become more expensive, and so it's become more attractive to have a pure financial hedge on the side. I think I might have missed a slide here. Did I miss this one? I did miss this one, didn't I? Sorry about that. I'll just backtrack. I must have double hit it. As I mentioned at the top, we did survey buyers on the impact of all the market volatility. And so on the left, you can see the survey of buyers. Most of them said it didn't have an impact on them, and then the rest were equally split between the brown positive impact and the blue negative impact. I think advisors probably have a better insight here, obviously being able to look across the market. So when we asked them if all this volatility was having an impact on PPA demand, we got quite a mixed response. But around 40% said it had a positive impact, around 20% said a negative, and around a quarter thought it said they had no impact. And that sort of mixed response reflected what we were hearing back from advisors. Some reported that there'd been something of a rush to sign PPAs as buyers were looking to get a fixed price deal in place to sort of get themselves out of the volatility, while others were saying, well, is now really a good time. There was rising prices for PPAs with operational projects as these buyers chased a dwindling supply. And for newer projects, there were supply chain costs coming through the pipeline. So some buyers, it did create pause. I feel like we have the sort of a different version of is this a good year for PPAs every year? The year before it was low prices. Why would I sign a PPA now? And this year, obviously, very exceptional circumstances. I think if you signed a PPA last year, you would obviously be very, very happy with yourself, buying yourself out of this. And so I guess the important thing is to try and keep a longer term perspective that thinks about the value of the certainty that a PPA can offer an organisation. I'll skip back forward here then. So the other outstanding trend that we've already mentioned is that we're much lower levels of PPAs with new projects this year. But for that very large deal at the end, the capacity figure there on the right would be very low. And you can see from the donut on the left, most buyers signed with either a project which is committed in construction or operating. There's a structural trend here, I guess, insofar as we have more and more retailers offering projects de-risked with operating projects, but also a cyclical one in that we hear that there was, I guess, a slowdown in supply and that the demand is not effectively being met. And there are more and more arrangements, such as bridging arrangements with retailers going on, where they're committed to moving them across the new generation as it comes online. I guess these sort of figures do give some pause for concern about additionality and the true impact of PPAs. Obviously, that we want to see, you know, the gold standard is a PPA with a new project and before it secures project finance for true additionality. But I think it's also important to note that whilst not every PPA with an operating project might meet a stiff additionality test, they're often still contributing to demand if they are, for example, procuring from a retailer that is signing a PPA, on selling, going back and signing more. There is an indirect effect. So really, I guess what we hope to see is actually a mixed market where you've got larger buyers signing with new projects and you're still seeing the operating PPA market segment as well, because without that, there probably isn't an avenue for to tap the demand of this sort of smaller and mid-sized buyers. I think it's important also to note that buyers at all scales can increase the impact, the environmental impact of their PPA, supporting new renewables, or demand matching that creates space for new projects to come online, or good community benefit sharing. And so we released a best practice guide last year, which provides some tips and ideas for buyers of all scales to think about how they can do a more impactful PPA. So I'd suggest you have a quick look at that on our website. So a few emerging issues that we might talk about in the panel. Obviously, we saw high prices for LGCs last year that was having an impact on buyer strategies. That has eased somewhat, seen to be driven again by less supply than expected and greater demand, voluntary demand from corporate PPAs than expected. So a factor to think about this year. There seems to be a lot of investment in new manufacturing capacity, but we're probably still in a period of ongoing supply chain constraints and prices. And what does that mean for the PPA sector? There's been some uncertainty about post-2030 arrangements when the renewable energy target finishes. What happens to LGCs? How do buyers meet their commitments, and what happens to pricing for certificates? But there is policy change on the horizon. The government's released a guarantee of origin scheme, and Green Power's review is also coming to a close. Some interesting policy changes on the horizon there. There seems to be growing interest in aggregations as larger organisations with smaller loads enter the market. And will we start to see more interest in demand flexibility, because the costs of mismatch between demand and the project you're buying for are more expensive? And we're starting to see the emergence of the 24/7 movement internationally, where buyers are setting targets to try and move to 100% matching between their PPA and their consumption. I think that'll start to filter through into the larger buyers in the Australian market as well. So that's a quick survey through. I'll hand back to Jackie, who's going to run the panel discussion. Just a quick note that you should put any questions that you have in the chat, and then we will come back to the chat once we've finished our panel, your questions once we've finished the panel discussion. Back to you, Jackie.
That's great. Thanks very much, Chris. And as we mentioned, you can access both the slide version and the full report version of that report online at our website. Just going to resources. Also to mention that best practice guide and also the local government guides are free on our website. So we'll just assume that you'll all be downloading them and reading them and knowing them inside out and back to front. So now we move on to our panel questions. So first up, we have Abhi Nithyanand from Core Markets, previously known as the Renewable Energy Hub. Abhi is Head of Advisory, Sustainability and Energy at Core Markets, and has over 10 years experience in the Australian energy market. He specialises in commercial strategy and offtake structures. And if you don't know Core Markets or Renewable Energy Hub, they are an end-to-end partner for business on markets, technology and climate solutions. So Abhi, just jumping straight into the questions here. So in 2022, we saw an increase in buying groups or aggregation developments. We know that you're involved in one or more of those. Do you think this trend will continue this year, and why?
Yeah, hi everyone. Good to see some familiar names and some new names as well. Yeah, I think definitely is something that we're going to see a lot more coming through in the next couple of years. And I think some of the early teething issues around even running aggregated processes have been ironed out, and you'd see these being run in a lot more faster and efficient way going forward. So once that we've got through some of those issues, I think it comes down to also why and what. So aggregation processes in general provide access to more commercial PPAs for smaller loads. And this is something we've seen through multiple PPAs, whether it was the previous QIC-IFM aggregation process or any of the council ones we did. And additionally, it's essentially providing that coordinated approach and allowing like-minded businesses also to make joint decisions rather than wondering what they're doing on their own. And lastly, we were both at a conference a couple of days ago, or yesterday, the Sustainability Leaders Conference, and there's a lot of focus on Scope 3, and coming back to someone's point over there, Scope 3 is someone else's Scope 1 and 2. And we're seeing organizations starting to look at, well, if it's my Scope 3, I'll start giving you the opportunity to reduce your Scope 1 and 2 through and therefore my Scope 3 emissions. And that's something we're currently actually working with IFM and QIC for another large aggregated retail PPA, which I think is going to hit the market next week. But essentially, it's letting all the assets that they own and their customers as well to reduce their Scope 2 emissions to long-term PPAs.
Yeah, it's certainly something that we've seen growth in. I think Australia are really the leaders looking across similar markets around aggregation projects, all sorts of potential opportunities to reach out to supply chain upstream and downstream in these sorts of deals. So it'll be very interesting to see if that focus on Scope 3 translates into more group deals. Thanks, Abhi. So 2022 also saw growth in the small and medium buyer purchasing, such as we mentioned earlier with Canva and HSF and Bupa. And I guess the question really there is, are energy suppliers or retailers responding quickly enough to the needs of this emerging market? What do you feel is needed to support more renewable energy purchasing in that sector?
Yeah, I think retailers are when they're given clear direction and time on exactly what you're looking for. Just as an example, last year we worked with a small organization called ESCO. They have multiple sites and their footprint is only about 8 or 9 gig. But when we went to market with a very clear outline of this is exactly what they're looking for, which we could do on the back of predefined strategies around how you address it. So as soon as you go to the market with a clear understanding and provide the retailers with good direction, as opposed to just shooting out there to get anything out, get any form of response, I think retailers can. I think 2022 was probably the year of most commercial innovation around retail contracts and retail PPAs. And we've seen the likes of many new retailers really pick up a lot of load on the back of this innovation. And yeah, additionally, I think it's being more strategic and having that view and working with the retailer on that is definitely getting them there.
That's great, because obviously, you know, it's important for receiving a competitive response from the market, having enough retailers to be able to invite in those tender processes. So yeah, certainly growth in that area is something that we'd be delighted to see. So I guess in terms of current challenges to deliver PPAs now, what are the sorts of I guess current challenges? We certainly do our best to work on some of the market barriers here at BRC, but what are some of the challenges that you're still seeing out there?
I think just the first challenge in itself is supply in the pipeline. You can see several developers and retailers on the call today, and that all attest to that, where there's a lot of project delays. I think someone put in a question about supply chain increases. So cost increases everywhere, project delays, and realistically looking at it, there's a significant amount of corporate demand coming through for 25 to 27 on the back of renewable targets and Scope 2 targets. However, the number of renewable projects entering the market isn't at the same rate. So I think the first real concern there is supply, and then after that, once you further add that in, and with a lot of these organizations, when you're looking at aggregation or smaller businesses, they also want retail PPAs. So that kind of links back to the retailer first having to sort out their supply chain with wholesale PPAs to then on-sell it. So I think there's a bit of a squeeze there, and potentially we may see organizations even changing their renewable energy targets and pushing it down from 25 to 26 or 27, depending on what happens with costs. And then the next thing I think is post 2030. So now that we've started looking at things towards the end of towards the second half of this decade, PPAs start to go well into the 2030s. And I think understanding the risk around that and it's quite important for organizations themselves to realize what they want to do post 2030, how renewable do they want to be, what other claims they're looking to make, and start to make that decision. I think Anglo kind of broke that barrier down for a lot of organizations last year by signing a long-term contract that goes out to 2035. And I think that's kind of paved the way for organizations to take that view. And then just generally, I think some of the things that we are also seeing in terms of challenges on retail PPAs, one is internal governance and sign-off processes, which I guess we've started looking at by tackling earlier in the piece and ensuring the entire organization's on board. I think we've all been talking about this for a while now, but same challenges still exist. And then firming. So again, we're talking about contracts that start much later. How are we managing the firming? And you could say it's a retail PPA, but at the end of the day, retailer has to firm it. So whether there are mechanisms of whether you got fixed price or floating variations on the firming, again, comes back to that whole innovation that's really going through in the market currently. And from smaller customers bases, just trading off on term and price and requirements around load and having the ability to think about what their load and their business might look like in 5, 7, 10 years is also being a key challenge, I guess, on the retail side. And then wholesale side is a whole stack of different issues, including supply chain, project delays, curtailment, network upgrades, and so on. I think we can spend another half an hour talking about that. So might just finish up there.
That's right. Yeah, indeed, there are challenges. There are also people who've managed to overcome all of those challenges. So some great examples there. We've got some case studies on our website talking about some of those challenges and how they've been dealt with. But thanks very much, Abhi. That was really helpful, and some really helpful insights into some of those other deals. Just moving now on to Daniel Trujillo from ESCO Pacific. Hi there. Is our developer representative today. Daniel leads the origination of PPAs and is responsible for supporting customers navigate and negotiate win-win commercial outcomes at ESCO Pacific, which sounds pretty good. He brings deep commercial, technical experience from across the supply chain. So thanks very much, Daniel, for joining us today. I'm just going to go back to that point that Chris made earlier around that swing back towards wholesale PPAs. And what were the sort of factors that you think have driven this? And do you expect this to continue this year?
Yes. Thank you. Hello, everybody. The wholesale PPA market from a corporate perspective has definitely picked up over the last couple of years. I agree with what has been said on the report and found on the report that higher prices or higher forecast prices and higher forecasted LGC, not just energy, but LGC prices, have to bring back the interest of larger corporates. I think that there's been, and it was really interesting out of the numbers that you show, how many people are increasing and how it's steadily increasing over the years, the interest to reduce their emissions, to reduce their impact, and through scope 2 emissions. And what we are seeing is businesses really going voluntarily to energy as a way of perhaps one of the fastest or clearest ways of offsetting their impact on in terms of emissions. Looking at their products and looking at their processes is obviously something that they do, and it's core focus. But changing the supply of energy is something that can be done pretty quickly. Perhaps changing a factory can take a lot more than finding and executing on a PPA for a long term. So yes, do I think that the trend is going to continue? I think yes. I think yes. We see a lot of interest on the market. We see a lot of processes out there that are well advertised, very large energy users saying that they are going to completely shift their consumption from contracts that are ending at a specific date with coal-fired stations. That is going to drive a lot of build, and then the LGC as an offset, and the high prices of ACCUs versus the price of an LGC, for example, make people consider, and will continue to make people consider these large projects.
Yeah, great. And I guess then your opportunity also here is to I guess help buyers to understand what are some of the challenges for larger developers like yourselves that you see in the year ahead. We've heard a little bit about project scarcity, etc., but how some of these challenges might be mitigated.
Yes, yeah, absolutely. Look, customers should put attention to all the macro trends that are happening. I think, like energy, obviously, and energy prices, although they may have softened right now for this quarter, last quarter were high. There is still a lot of volatility, and they are likely to go up. Another thing is inflation and costs and supply chain and production and geopolitical issues between the powers to be right now on the world. I think that all of that creates those are the macro trends to consider. The other more local macro trend is that we are definitely decarbonizing the network. So we are going to close out some of these old generators and bring new capacity. Capacity will need to be built, and there will be more and more people wanting to claim green. So it's cyclic, but there is going to be points where people need to look when to contract. Look, right now, I think that the industry developers, we are facing headwinds and tailwinds. The tailwinds definitely have come from higher prices and a higher interest to decarbonize from customers. A higher LGC price as well, and customers looking at LGCs as a potential as offsets. So those are all good tailwinds. But then we have the headwinds, and they're not necessarily what people think about, but interest rates, the same way that they have affected anybody in your personal finances, or if you work in treasury, then you understand it has a big impact on the cost of project finance. So you have the capex. You have the OPEX, which is small during construction. The CapEx itself, it's relatively flat. Sometimes coming down. Labor is going up because inflation. Exchange rates. I was looking at how much the Australian dollar is right now, and I think he's buying 65 cents of US dollar. So, and interest rates for project finance, 60% of the cost of the project finance of the project is driven by higher interest rates, and those are absolutely higher right now than a couple of years or even a year ago. So those are the headwinds on the other side. But at the end, what I think is we and all the people that are here, 400 people that are attending, we all recognize that it's happening. It would need to, as I said, there is macro trends that are setting that this needs to happen. So so at the end, it's about finding the right project. I always say that to people, to customers, find the right project. There would be reasons why that project aligns well with what you want to do. Find that extra value that can be created from the transaction. Don't look for a cheap sticker price. These wholesale PPA transactions are complex transactions, and there is multiple pools of value that can be bring together and free up and shared in different ways to make them possible.
And just really quickly, another question that we're often asked is, are there approvals and network connection times? Are they something that is currently a bit of a challenge in terms of timeframes and bringing projects on? And is that really sort of affecting any of the terms that can be negotiated right now?
It's going to be, look, right now there is obviously projects that have approvals. There is projects that are close into grid connection. I think that we saw a bit of a lull, as everybody has mentioned, over the last probably 2 years. In that sense, there was a lot of capacity already built and lots of people just looking for LGCs as offsets. That saw offset type PPA, LGC type PPAs and retail type PPAs very quickly move. Now the next phase comes, and people that want to be able to show additionality will be able to find these projects. There is projects in the market. As more people come in the market, there will be less. Absolutely. Grid is always challenging, but it's of course moving more. I have no specific view about what may happen once the renewable energy zones start being built, and how the networks will manage perhaps existing pipeline of projects in other places versus building in there, contracts on the rest at a certain price, but that will get delivered. Yeah, it's going to be timing. It's going to be very interesting. I think that people should keep an eye on timing. They should look at what they need and what they want when, and consider all those things. But there is definitely projects in the market maybe not enough, but there is projects in the market that will happen at the right price.
Okay, that's fantastic. Thanks very much. And you really answered my question around interest rates and higher LGC prices already. So we'll just move on now. Thanks very much for that, Daniel. Really insightful. Moving along now, we have Niall Brady from the Clean Energy Finance Corporation joining us today. Niall leads the CEFC's solar and storage platform and is responsible for the origination and execution of investments. So he can tell us a little bit about investments in projects. Since joining CEFC in 2014, Niall has played an integral role in the development of the $3 billion CEFC renewable energy portfolio, accelerating the delivery of more than 5,000 megawatts of new generation capacity. Thanks very much for joining, Niall. The question on many people's lips, what is the current focus for the CEFC? I think you might be on mute.
Sorry, COVID's only been happening for 3 years. I'm just getting used to it. Look, thanks for having me here today, and thanks everyone for tuning in. So look, for those who don't know, the CEFC is the Australian government's $10 billion green bank, and we invest in renewable energy, energy efficiency, and low emissions technology. We've been around 10 years, but look, this year we have had a change to our act, which is going to majorly focus our attention for the next to 2030, I would say at least. So we've always had the objective of facilitating flows of finance, so essentially crowding in third-party capital. So one of our major KPIs is for every dollar the CSE invests, how many dollars is the private capital markets investing? But we've got a new leg to our objective this year, which is to support the Australian government's emissions reductions targets. And look, that's going to be the big one for us. So we're looking at net zero 2050, but coming quicker than that is 45% by 2030. So when we look at that will really be our direction in the coming years. When you get into the modeling of what 45% by 2030 is, it becomes the electricity sector pretty quickly. That is the bulk of the heavy lifting in that. So I think our key focuses are going to be, as expected, green generation, but also creating that energy system that allows high levels of penetration. We need 82% renewable is roughly the number that gets you to the 45% emissions reduction. So building out the grid, demand response, electrification, and short and long duration storage are going to be key.
Yeah, fantastic. And so how do you anticipate investment in renewables will shape the market this coming year?
Yeah, well, look, I think 2022 is a tough one. I deal in greenfield solar and storage. So yeah, we experienced all the troubles. I've been doing this nearly 10 years now. And it felt like back in the days when solar was pre-commercial and we were getting models, updating the capex and interest rate, and just couldn't get them to add up. But look, I'm bullish on the industry, and I think even with that, the industry still got things done. And if you take 2022 out and just kind of look at the last 3 months from December, including that Microsoft PPA, we've seen about a gigawatt of solar and 2 gigawatts of wind in the last 3 months. So I think we're seeing the green shoots start to emerge. And look, we're seeing capex start to levelize, and I think that will really help. In the CFC, we sit at a strange intersection of the market. We don't have any competitors, so everyone comes and talks to us. So on one side, we see all the developers and people trying to get projects up, and they're all very committed to bringing projects online and making them investable. What I find about developers, they're real problem solvers. You throw something at them, they always just keep coming. I'm sure Daniel spends his day solving problems. And look, they will make investable projects. But then on the other side, we see all the banks, all the institutional equity, all that sitting there. And that is all like lined up and really wants to join in and really wants to fund projects. So I have no doubt that the industry will supply the projects, and we will, the capital will invest in them to build them out.
Great. We're seeing some really innovative things from some of the retailers in terms of deals and bringing people on at different, bringing projects on at different times for some of our sort of retail PPA customers. So, there are certainly deals out there. So what do you feel is needed to maintain the momentum? And what's affecting project availability, and how do you see it being addressed? It's quite it's a triple barrel question.
Yeah, a lot there. But look, I think there's some short term, and I like Daniel's headwinds and tailwinds analogy. But I think there's some short term headwinds there, which are evening themselves out. I see capex is starting to levelize. Like from the quotes we were getting kind of middle of last year were very difficult, and I think towards the end of last year they started to levelize and come back to something that might be able to get projects up. But I think if we look longer term, we really see, look, Australia has a grid that was designed around centralized coal, and so far renewables projects have just slotted in where they can find capacity. And to get to like 82% and high penetration renewables, we need a grid that allows more projects to enter, and we come to a decentralized grid. So we need the future grid. Luckily, the Australian government has responded to that and it has seeded the $20 billion Rewire the Nation program. The CFC will manage the financing and investing side of that 20 billion. And look, we'll work closely with the states, but really what we want to see built out is the transmission, the interconnectors, the reses, and look, there's also the long duration storage, balancing, and ensuring reliability and security side of it that has to be managed as well.
Yeah, fantastic. And so just wrapping up quickly before we jump into the questions, and thanks everyone, we've got a really great, strong list of questions here. We probably won't get through all of them, but we're delighted to have them, and hopefully we'll get through most. That question around the higher interest rates and how that's affecting financing of projects and PPA offers, do you have any sort of comments on that one there, Niall?
Yeah, so look, rising rates have definitely hit projects. We were financing projects 12, 18 months ago. Debt was costing 3%, and now today a little under 6%, I'd say. So that's what we've seen happen. I think if you look historically though, the 3% is probably more of an outlier than the 6%. We may have been a little spoiled with 3%. And we've also got to consider the effect that has on equity as well. The interest rate sets where equity hurdles are, so we can expect that to most likely. And also all the quantitative easing money that came in also drove demand from the equity side, which drove equity returns down. I think we're going to have to get used to probably a higher level of interest rate. But look, there's some tailwinds coming through, as Daniel said. And look, capex levelizing and higher price forecasts, both green products and electricity. If you're there today and you're thinking about a PPA, the price of the PPA isn't the value of the PPA. The value of the PPA is the difference between the price and what the market settles at. So, you know, locking in that
Well put.
and using that as your value metric is probably the key. Like, prices were very low in 2019, but LGC and electricity prices were also very low. So, you know, it's two sides of a coin.
Fantastic. Niall, thanks very much for your views. Thanks to all three of our fantastic speakers there, and also Chris. And handing back over to Chris now, just we're going to attempt to answer some of your questions. Chris will kindly field those to each of our speakers. Please be nice.
Jackie, yes, I've been reading through the questions, trying to organise them for our panel, and we'll try and get through as many of them as we can. So I'm going to throw the first question to Abhi. One of the first questions was, has there been any change in trend in terms of the length of PPAs signed?
I guess yes and no. So in terms of length in PPAs, typically it's almost a trade-off between term and price. When developers are looking to use a PPA to secure offtake, they are looking for the 10-year requirement there. So typically the wholesale ones or long retail linked PPAs would go for the 8 to 10, because that's essentially what you need for project finance, and therefore you get a much better price. But having said that, there are organizations who can't go beyond 3 years or 4 years or 5 years. So there are shorter term PPAs with operational assets that we're seeing out there, but that's the trade-off, is the price over there. So, and again, going down to that, we typically see that you'd rather have that conversation with the exec and the broader team well before you embark on the journey of make sure they understand the trade-offs between the two and why 10 years is a foundational PPA versus a 5 or a 6 year option there.
So different market segments, but not a clear trend towards shorter PPAs than, you know, with the 2030 end date of the RET or anything, or the uncertainty or anything like that. I
think last year and early parts of last year, or early starting contracts are going towards 2030. And this is my personal view, is I feel like we're going to be hitting a big contracting cliff on the 31st of December 2030. So kind of already with businesses, I'm working on moving them away from that period, but potentially for PPAs that we're looking at down the line, which are starting much later, 2030 just seems a bit too short in any case.
Okay, we'll return to the 2030 question, but there were several questions from people, I guess, around shape of PPAs. One question was, are we seeing more buyers seeking fixed shape products from generators like Neon, baseload PPA with BHP? Another one was, what's the market appetite for shaped PPAs, battery storage plus solar plus wind products? And I think all of you could answer this question, so I'll throw it open and see who wants to bite on it.
I can start. Yeah, I guess that we are seeing like another part of what we do is we work with developers to help them secure offtake for their projects as well. And yeah, we are seeing more ship offerings come out there, whether it's a peak only swap or a baseload swap. But again, I guess that comes down to both buyer and seller, where as a seller, what's the risk they're willing to take on? There are developers out there who don't want to take on any more merchant risk other than just a pay as produced. And then there are other sellers who are a bit more advanced in their way they manage their positions, and it comes down to their internal risk mandate. And similarly on the buy side, again, comes down to some retailers would rather take on a pay as produced and manage the risk themselves, versus other customers or retailers who prefer to take a firmer project. So yeah, in short, we're seeing a lot more of these shaped products come through, but I don't see it as being the norm, because you really need the right buyer and the seller for those products.
Right. I might direct the question more at Daniel and Niall. We had one question about how will the Inflation Reduction Act from the US impact on local renewables markets? Is there enough incentive in the local market to keep international developers here? Might be one for Daniel and maybe Niall as well.
Probably for Niall, that he looks at the market. It's
yeah.
Well, luckily I'm only allowed to invest in Australia. But look, as we see investors, look, the Inflation Reduction Act, I think we're really trying to find our feet with it and figure out exactly what it means. And look, I think for things like hydrogen, you know, it probably tilts the playing field towards the US from what I'm reading. I think regarding development here, look, I think developers will develop projects anywhere they think they can get a market. And look, with Australia's targets towards 2030 and towards 2050, there will be a market here for renewable projects. And I think that it's probably more likely to tilt supply chains than to tilt developers, I would say. Daniel, you're not, I hope that's a good thing.
I agree, you know, like energy is local. It needs to be produced here to a certain level, you know, until we get to hydrogen. So I agree with you as well. I mean, if we can ship it and take it to other places, we can worry about. But I think that supply chains, you know, like the extra I think that the impact is slightly different. You're right. I think that it's more like supply chains and products and people may look to different markets and go there. But still, Australia is a lovely place to be, isn't it? Like it's just beautiful here. Why would you go to America if you can live here?
That's right. And be part of the BRC-A when, you know.
Well, we'll see if the attraction of all those subsidies and whatnot creates an impact. I'm sure it's going to have an impact on supply chains in particular as it starts to accelerate. We had a few questions around the end of the renewable energy target, the new REGOs, Renewable Energy Guarantee of Origin, which is a new type certificate being proposed by the federal government to replace LGCs. So questions, what is your impact? What is your view of the impact of the REGO, the Guarantee of Origin scheme, on PPAs and LGCs, and what's the future outlook for LGC only agreements? I think, Abhi, you started to go there when you started to talk about the contracting cliff coming in 2030. Do you have a view on, or have you had a chance to have a look at the new certification framework, and do you have a view on implications?
I think it's right at the start. Most PPAs were anyway looking to kind of account for REGOs through green product rights anyway. And now it's just, I guess, another step forward in terms of what are those green products going to look like and how they come through. So we're seeing a fair bit. Historic PPAs were fixed price with escalation year on year, and the value on these green products and rights and the requirements on how this was structured was quite important. And it certainly is moving forward as well, but we're also seeing alternate structures around how contracts are priced and how they're structured to account for REGOs. And again, if it's not REGOs or an extension of LGCs, then there are other international green products that you could be looking to use and so on. So yeah, definitely, I think it just providing further certainty on post-2030 era on what that product might look like. But I think most contracts were already accounting for something being there for the buyers.
It's certainly been a question that we've received quite a lot of, and one of the prompts for us to provide a policy roundtable for particularly for buyers to understand what might be happening in this and a bunch of other policies impacting on PPAs, and understanding safeguard mechanism, those sorts of the cert guide and those sorts of aspects. So it's something that we'll hope to provide a little bit more on in the future.
Yeah, I think it's interesting that they're clearly trying to create as much continuity as possible with the existing framework to try and smooth the pathway from one regime to the other. I think one of the interesting points of difference is that the regos are going to provide more information on the time of generation, the location, whether it's storage or renewable energy. And there were a couple of questions around pricing, and I think it's pretty early to be trying to work that out. But I think one of the interesting potential implications is that you'll have different segments, different pricing for different certificates, depending on these characteristics, which might be more attractive to certain types of buyers. That's an early, I guess, implication, but I think that's an interesting one to unpack and sort of as we get a bit more information around it and people get their heads around it. I've got another question which is specifically directed at Abhi. Question is, Abhi mentioned efficiencies in aggregation. We regularly discuss the challenges of aggregation with our clients, but do not specifically seek to dissuade them. Aggregation can aid the gold standard mentioned by Chris Briggs of New Generation. Can Abhi articulate a little more about the specific initiatives that have improved the efficiency of aggregation, standardization of contracts, use of technology for stakeholder management and comms?
I think starts off with stakeholder management and comms. Essentially, I think earlier aggregation was more about a bit of an ad hoc approach to market and so on. But I think as a market, we've all learned a lot more on how these deals have worked and where the biggest pitfalls have been. So just streamlining processes, getting the key champions on board from each organization, but also I think getting internal approvals from organizations on what exactly they're signing up for, and getting that endorsement has been quite key. And then after that, entering the market with very specific requirements and specific focuses. And again, getting all organizations on that pathway to sign off on these specific products has also, I guess, allowed the retailers or the developers to essentially provide very specific pricing and provided the opportunity to innovate. So I guess compared to an aggregation program that would have run about 18 months, running one now would probably improve time, efficiency, and cost by about 40 to 50% there.
Yeah, we're seeing a lot of activity in this space at the moment, both from the public and the private sector. Some of them are also association-led or public sector-led initiatives, these aggregations. We've got a little bit of information from some of those projects that have executed on our website. Have a little look under the aggregation page there. But there's more to come on this. We're also we will be running the aggregation session as part of the small buyer training that we're doing shortly, and we also have sections on that in our boot camp. So a few tips for buyers, particularly in that space.
Do we have time for one more question, or are we wrapping up? It's 1 minute to 1, I notice.
Look, we probably are going to run out of time, I suspect, to have a really genuine answer for you there, Chris. But look, I just wanted to say thank you very much to Abhi, Daniel and Niall and Chris. And also big thanks to Alex Nasser, our project officer, for organising this session. Did a fantastic job. Please do jump on and check out that buyer training if you're a small to medium buyer. Also jump on and have a look at our boot camps page and have a look at you can register your interest for that at the moment. We'll be looking at numbers and basing our decision on timing around that. And there are a whole bunch of other bits and pieces. We'll be reaching out to you, the buyers, for membership renewal shortly as well. But for now, that's basically it from us. Thank you very much. And please continue to send through questions. Our market advisory panel addresses a lot of these issues. We've got particular subgroups dealing with a lot of the issues that we've talked about today, so they don't sort of float off into the ether. They do go back into the BRC, and we look to how we can support you on those. So thanks, everybody. Have a great Friday.
Thank you.
Take care.
Thanks all. See ya.
All right.